Welcome, everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance. As many of you are aware, the SBIA is the advocacy association for investment professionals focused on America's lower middle market companies. Our association has maintained a key role in promoting the growth and vitality of this industry and the small businesses it supports for more than 60 years. We're pleased to bring you our Lunch and Learn webinar series with today's topic, M&A investment considerations in a COVID-19 environment. Our series of webinars is designed to provide useful educational content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. A couple of housekeeping items. If you have questions for our speakers during the session, please use the questions feature in your GoToWebinar menu bar. We will monitor this section and address questions as they arise throughout the webinar. Also, please use this feature to let us know if you're having technical issues, and today's technical director, Ainsley Hoffman, will reply with suggestions. Please note that this session is off the record. Comments, statements, and materials are for the express use of SBIA members and are not to be published or recorded without approval by SBIA and Troutman Pepper. Today's session is possible because of the support of our longtime and newly merged sponsor, Troutman Pepper. The firm completed its merger on July 1st and now has over 1,100 attorneys in 23 cities. Troutman Pepper's SBIC practice is one of the country's largest and most active, advising more than 280 SBICs since 1994 in obtaining their licenses, structuring and raising capital, and assisting clients with regulatory and compliance matters, operations, and investment and financing transactions. Joining us today, we welcome Chris Rossi, a partner in the Corporate and Securities Practice Group of the Commercial Department at Troutman Pepper. He is chair of the firm's SBIC practice and co-chair of the firm's Private Fund Services Group. We also welcome Alec Watson. In addition to his work with private equity firms, Alec represents public and private companies in M&A transactions and serves as outside counsel to portfolio companies and other private companies. Finally, we welcome Chris Miller. Chris concentrates in the areas of mergers and acquisitions, private equity, venture capital, securities, technology law, and general corporate matters, and he represents public companies in ongoing reporting and compliance matters. Contact information for the entire Troutman Pepper team will be provided at the end of the presentation. Chris Rossi, if you and your colleagues are ready to get started, the virtual podium is yours.
Thank you, Mary Brown, much appreciated. So welcome everybody. Thank you for taking time out of your day to attend this Lunch and Learn session. We're very excited to have the opportunity to do this with you. Today we're going to be talking about considerations in the COVID-19 environment with respect to investments, including M&A transactions. When the pandemic first started, M&A activity almost came to a halt, and you saw headlines and articles about deals that were signed where perhaps some things were going sideways in them, ranging from material adverse effect conditions being argued to have not been satisfied to breach of contract by the target companies for taking actions in response to the crisis. Time has passed, and now we're seeing a loosening up of the environment with respect to investments, particularly in the lower end of the lower middle market, which is where we play and where I think most of you play that are on the call. So we're going to have a discussion. It's going to be a roundtable discussion about what we're seeing in the marketplace and things that you all should be considering when you're doing your investments. Ainsley, if you can go to the next slide. So we're going to be covering a series of topics with respect to the process and various considerations that we're going to need to be considered when doing these types of transactions. I'll note that each of these topics could be a webinar unto itself. So we're going to be covering a lot of ground in a very quick and high-level fashion. But these are the topics that we are going to be covering. So let's go to the next slide. So Alec, you know, we're going to talk about the transaction processes and what we're seeing today in terms of how deals are getting done from the origination of the deal, the finding of the deal, the pitting of bidders against one another. If there's an auction process, maybe there are different kinds of processes. What are you seeing getting done in the environment right now.
Chris, as you said, I mean, things have evolved a little bit. I think certainly early on, you saw a lot of auctions where maybe they had just started and hadn't gained a lot of traction yet, and the plug was pulled. Or, you know, we had a couple of clients certainly who were gearing up to sort of April 1st kickoffs. Those got pulled and are still sort of on the sidelines with people reassessing their plans there. So that was, you said, was sort of the initial thrust once the virus really, everybody sort of really realized its impact. Since then, I think we've seen sort of two distinct types of deals. One is, you know, the attractive asset, right? Something that is a really attractive asset in this market that's financeable, that the lenders get excited about, and that the seller feels like is has a high level of confidence they can sell. We've seen those go in auction processes and seen what looks like a quote normal deal with multiple bidders and in a truly competitive situation. The other thing we've seen a lot of are sort of tuck-in acquisitions where you've got either portfolio companies or strategics who probably have a good-looking balance sheet, maybe flush with cash, and are going out and being opportunistic. A lot of their targets end up being, from our experience, maybe smaller companies, maybe family-owned, likely don't have institutional money, and they're scared, right? And they view this as a chance to maybe cash out, and this is their chance to get out, eliminate the risk or reduce the risk by taking some money either off the table or selling entirely. So we've seen a good number of those as well. Those deals can get done because they're getting done without financing or with minimal financing. And, so I think that's sort of the other piece that we've seen a good bit of.
Chris, are we seeing leverage deals get done?
Yeah, so from my experience so far and from those of our colleagues that we've talked to, we have not seen deals that are significantly leveraged getting done. And there's an exception here and there, but by and large, the highly leveraged deals are really sitting on the sidelines due to the tightening of the debt markets. I think the deals that we're seeing that are moving forward are those that are either going to have a very small debt component or even no debt component where it's 100% equity. So I think as we start to move out of this, I think they're going to see some loosening of the debt markets and some lenders that are more willing to come in. But right now, the predominance of the deals that are actually getting done or at least moving toward getting done are those that require at least limited debt, not the kind of significant leverage deals that we were seeing before the crisis.
Yeah, and I think that's having an impact on how deals are getting structured. And we'll talk a little bit later about closing mechanics and getting the deal done. And all of this interrelates with one another, particularly on the decision as to whether or not you need to have an exclusivity period or not. So, we are, the markets are still developing in this regard, relevant to getting committed financing and the conditionality of those commitments. And as I think Alex said, we're still seeing full equity backstops, but there's even some push on that given the nature of what's happening here. Ainsley, if you want to go to the next slide. So we start with this topic because we think that the PP loan issues that companies face are indicative of the kinds of things that one has to think about as we go through the other parts of the transaction. So impacts on purchase price, for example, the diligence that needs to be done on the PPP loan, supporting representations and warranties, and interim operating covenant matters. But we're getting a lot of questions now that, the world's hair was on fire back at the end of March and early April. And I know Chris and I were spending oceans of time on counseling clients on PPP loan matters, affiliation rules and the like, particularly those SBA ones near and dear to the hearts of the private equity firms, some of which were potentially shut out from getting PPP loans and some of which were able to do so through some exceptions or through some modifications to their governance documents. But how to handle a PPP loan is now becoming an issue. And, the issues range from, do we just pay the thing off to, well, should we lose the economic benefits associated with it? When the CARES Act was passed, the theory was come June 30th, we were going to begin to see a normalcy of economic activity. And I think that's part of what we're beginning to see, at least through investment transactions that are being made. Chris, you and I have been dealing with this more recently with some deals. What kinds of, alternatives are we seeing relative to how PPPs are being treated from a diligence, purchase price, et cetera, perspective?
Sure. So, Chris, to your point earlier about any one of these topics could be a webinar in and of itself, I think this is probably the most significant because we've been dealing with these issues almost nonstop, both in deals that we're directly involved in and those where we are just tangentially involved in because of our PPP expertise. So there's a lot of considerations from the beginning through the end. I think it starts, as the outline shows, with the diligence process and diligencing the target's initial application and whether all of the certifications and the employee headcount and payroll amount were properly calculated, to the use of proceeds since that time, making sure that everything was done correctly, including segregating funds and using it for all the appropriate uses. But then I think the real fundamental question on PPPs is whether buyers are going to require them to be paid off in advance or whether they are willing to essentially assume them in the process because there is no ability to get a quick forgiveness. As we all know, the forgiveness process here is really could be up to 150 days or even more, but there's an initial review by the lender and then another of a 60-day period and then another 90-day period for SBA to take a look at the forgiveness application. So in terms of deals that are trying to get done right now, there really is not the ability to sit on the sidelines. I think it would be a very unusual circumstance for a seller to be willing to sit on the sidelines until its forgiveness application was finished and then to close the transaction then. So the real question is a buyer going to require that the loan be repaid as a condition to closing or not? If the answer to that is, well, the considerations there are primarily around some of the reputational risks that we saw some of the private equity funds really shying away from early on. Some private equity funds, and one that we're dealing with right now, kind of basically made a absolute no way we are getting involved with a company that has PPP funds. Certainly not PPP funds on its books when we buy it. So there are certainly some funds, some of the larger buyers that are just shying away from this and steering clear. Others that are willing to entertain it then say, okay, how are we going to deal with the outstanding PPP loan? And what's going to be the process for forgiveness and how do we deal with it, whether or not it gets forgiven? One situation that we saw where the private equity fund buyers basically said, hey, we're not comfortable allowing the seller to get the benefit of the loan forgiveness. We don't think that it was the government's intent to loan money to these companies and then have it increase the cash on the balance sheet for the sellers. And so therefore, we're going to buy the company with the PPP loan outstanding. We're going to apply for forgiveness on our watch. But then if the PPP loan is forgiven, we're going to leave the money in the company's bank account as opposed to paying it out to the sellers, because we think it was intended for the benefit of the company rather than the owners. Others are taking a different position, and certainly we haven't seen anything in SBA guidance that says the sellers of a business can't get the benefit of the PPP loan forgiveness. So in that situation, it's really coming down to, okay, are you going to reduce the purchase price at closing and either hold back the amount of the PPP loan or put it in escrow? And then when the forgiveness decision is made down the road, pay it out to the sellers. And so it's going to be really a question in those situations of how do you deal with the PPP loan? Is it going to be required to be repaid or not? And if it's not going to be required to be repaid, how are you dealing with the proceeds once the forgiveness decision is made?
Yeah, and a lot of this will also depend upon how this transaction is structured. So that discussion really was in many ways focused on, an equity-oriented acquisition. Asset deals may present a more nuanced issue. One thing just to make clear is that if there is any change in the percentage ownership of the borrower, at least the note that SBA published as the form note for this, which many banks did not use, they used their own form, but I suspect it would also include a lender consent to a change in control or that kind of transaction. Everyone has to remember that a PPP loan is a subpart of 7A, of the 7A program. So there is a whole body of standard operating procedures, SOPs, and guidance and procedural memos that SBA has issued relating to this topic. And SBA, a lender would be prohibited from providing its consent to any change in ownership of a company if that change in ownership is occurring within 12 months after the loan was dispersed. All PPP loans have been dispersed within the past 12 months. So the lender is going to have to get SBA approval for that. We understand SBA is providing these approvals. They ask for various means of information and the like, and there's back and forth. And I understand they've been fairly responsive with it, but we're at the beginning. I now understand as well they're getting inundated with these requests. And I also understand through third-party hearsay and the like that they're going to be proposing some guidance relative to this to handle. Because remember, there was no credit underwriting when these loans were given. It was an outsourcing of the unemployment function to the private sector in order to keep people employed, and it's intended to be forgiven. So the risks of repayment as a general matter should be low. However, if the money is not spent on proper purposes or forgivable purposes, and if the loan was made to an ineligible entity, that entity is going to be responsible for paying. So that's the framework within which some of these companies are thinking about this topic. It's going to permeate throughout the agreement. So anyway, next slide.
Hey, Chris, before we go on, we got a question in asking why some of the larger private equity funds are not willing to buy a company that has an outstanding PPP loan. And the answer to that was some of them made a decision early on that they didn't want to have any involvement with PPP loans. So even if they could, and I think most of you in the SBIC world kind of were like the prettiest girl at the dance because there were so many large private equity funds that couldn't otherwise, without having an SBIC investor involved, be able to take down any PPP funds. And so once the PPP standards came out and it was clear that any company that had an SBIC involved could have PPP funds, certainly a lot of those companies were applying. But then there were a certain segment of the sponsor world that said, no, from a reputational standpoint, even if we're eligible, we do not want to be involved. And so they either made their companies pull back their applications or they had them pay back the money early on because they didn't want to be involved and be seen as, even though they have the alternative resources available to them of a large, well-funded sponsor, they didn't want to have that reputational risk of having taken government money. And so that's really the reason why some of them are choosing not to get involved in any way.
Yeah, I mean, from mid-April through May 14th, ultimately, we were spending a lot of time with boards and sponsors and companies, walking them, in or off the ledge on the question of whether or not they, made the certification in good faith. And that's part of the diligence that one will do to determine, the risks associated with that. The other consideration, frankly, it's not just PE sponsors. Financing sources, to the extent debt is going to be provided, there are some lenders that don't want to deal with it either. They just want a clean balance sheet. They don't want to have to negotiate whether or not it's funded indebtedness for a period of time or it's not. And then if you don't get forgiven, it becomes it and you start violating covenants, and it creates a whole host of complexities. Potentially, I'm of the view that people shouldn't do that. They should take the time. These were intentionally provided for companies to do what they did with it, and that, they should get, everyone should get the benefit of it, not because it's a windfall or because it was a bailout, but because, it helped preserve and support the ongoing operations of the company. So anyway, you heard Rossi's speech on that. It could be longer. Anyway, next slide. Bueller.
It's up.
Thanks, Ainsley. There was a delay, I guess, in mine. Anyway, so the pandemic and all the surrounding, circumstances relating to it have created a myriad of issues. Among those are how due diligence is being conducted and practical considerations associated with, the diligence process. Alec, we were talking a bit about that and some of the frustrations that exist when you're dealing with diligence. What are some of the things that you've seen from, I know you represent strategics as well as financial sponsors. Are there any differences in how they're conducting due diligence?
I think it's interesting just because you sort of look at the baseline, especially if you take financial sponsors, right? The relationship with that management team is critical, something they're always focused on. And there's a playbook, right? They get to know people, they try to get to know them over time, or maybe it's an auction that they don't know the counterpart, but they spend time with them. They spend face-to-face time. We have management meetings, and all that happens. And so now, when you're in a situation where that's either more difficult or not possible, then I think it causes them to look at their model and say, hey, do we do this? Are we willing to go invest behind the management team that we don't know? And I think that's tough. When we've done it one way, it's really tough to pivot. We've certainly, anecdotally, in some of the deals we've seen, while it's obviously more difficult to make those face-to-face visits happen, we're seeing them still happen. I just think it's a lot to ask to meet over this medium and say, hey, we're going to get comfortable with somebody when you can't shake their hand, you can't see them face to face. Another thing we've seen, sort of heard this from a couple of folks, and actually have a sponsor client who can't say this for sure, but it certainly they feel like being locally in proximity to the target is actually an advantage here. Whereas, before, you hop on a plane, you fly across the country, no big deal. You can do that for board meetings. You can do that for management team presentations face to face. Now, when you can't do that as easily, actually being in the same city or state matters. And we did have one client who feels like, it wasn't, everybody always looks at this and names all the different considerations when we all know it's mostly price that wins the day in a lot of these processes, but they really felt like being local gave them a huge advantage. So that's just sort of an interesting twist, and we'll see whether that, as things hopefully at some point loosen up, what impact that has.
Yeah, I think it all relates to integration considerations at the end of the day, right? I mean, I think there are some items that, kind of customary and people did the diligence and they took it seriously, but I think there are some particular areas that are taking on greater significance now. For example, everyone or a lot of people are working remotely. Can the business operate remotely? How have the IT systems held up and the like? And, how is that all going to fit in with what we're doing? I was talking to one sponsor who, they're willing and they primarily provide credit. They're okay with tuck-ins and the like, particularly with deals where perhaps the sponsor had already done the management team visit, prior to the, really when everything turned sideways, and now they're coming back to potentially, finish the deal. But they're not really doing any sort of platform acquisitions. It's just very difficult to do in this environment. And, to adhere to your fiduciary duties on the diligence side without seeing the factory, without seeing the operations is just, I think, very, very difficult.
Yeah, Chris, I was just going to say that in the technology world, I do a lot of deals in the technology space, and those deals are much easier to get done because you don't have as much fixed plant to be looking at. So I think that the more technology related transactions are moving forward at a faster pace than those that are traditional bricks and mortar, where it really is important to get a site visit and to get to see the facilities.
Yeah. And, another thing that people are, looking at, we had a whole team at Pepper devoted to reviewing insurance contracts and any contracts for their so-called force majeures or their outs or whether there's coverage. I mean, a lot of this stuff is, in the miscellaneous section, right? And everyone says, oh, that's all boilerplate. And now suddenly boilerplate is taking on a more significant meaning. Toward the end of this, we're going to talk a bit about the representation and warranty environment. And, you know, the market is developing there, but where the hot buttons are for pushes and pulls. And so, you know, again, I think, you know, diligence is taking on a really significant role now, much more so with a different eye toward continuity, business continuity systems, because it's all being really put to the test right now. And it's going to become something that I think we're going to see a lot of going forward. Ainsley, the next slide. So let's talk a little bit about representations and warranties, because as we know, the representations and warranties are what reinforce the matters that we just discussed on diligence and the ability to close. So, you know, these are being done, one, buyers want them to, you know, ensure that the price that they're paying is, you know, is going to hold based upon an assumption that certain things are true. And we're beginning to see, or we really saw some really broad COVID-19 type impact, almost ridiculous buyer side representations and warranties that no one could make, but they were potentially designed for disclosure purposes. So, I mean, you know, Chris and Alec, talk to your experiences relative to the kinds of representations that you're seeing on this, and whether they're interwoven with the specific reps or whether they're seeing a general, you know, rep on this topic.
Yeah, we had one deal in particular where it was a unique situation. Our client was on the sell side, and it was a company that manufactured and distributed PPE, and so their place in this market was sort of inversely related to, you know, to the everything else is going downhill, but their business is going up. So with a lot of these considerations, were sort of flipped upside down. We got a markup back from one of the potential buyers with, you know, a laundry list of things, you know, similar to some of those items you see on the screen there, right? No defaults on contracts, no reduction in customer demand, no modification in customer orders, no labor shortages, your employees are all available, no supply chain issues, you can maintain adequate inventory, all of these issues. And our client looks at this and says, we can't say any of that, right? Every single one of those are the issues that we're dealing with day to day. And those are the things, you know, this was no secret, right? These are coming up real time in diligence meetings amongst the various management teams. You know, nobody's hiding the ball here. We can make it. You know, a buyer says, hey, look, if you want to, in this situation, we were asking for a carve out, an exception from MAE for COVID. And they said, if you want that exception, we need to get diligence around what the exact effects are. And our point was, you know, the effects, it's crystal clear, right? Yes, we're having all these issues. And, you know, that's why you're interested in the company too, right? Because there's a lot here. So that's a tough back and forth. You know, and you're seeing it called out there. The other thing that you need to be careful for is not the sort of express COVID, that was easy to look at and respond to, but sort of the more hidden potential impacts, you know, things like the absence of changes rep, where you're going to have to look at certain items over a period of time and say, have you had any of these issues, where normally they may not be an issue, but now it is. We were really focused on, in all these deals we've done in the last few months, material customers and suppliers rep. You know, that's a tough one to be able to say, where the buyer wants you to say that here are our material customers, here are material suppliers. We've had, you know, no material change to the relationship. Nobody's looking to change terms. And again, those just aren't true in a lot of cases right now. Terms are changing. There are changes. You're not guaranteed that somebody's going to be around to buy from you in another month. And so, you know, when you look at those reps, those are ones we really need to pay attention to make sure that that's not something that trips you up, either in terms of a breach rep or a potential bring down issue. If you've got a signing and a delayed closing, you don't want some customer issue to come in and potentially, you know, lead to a breach rep there.
Yeah, I think in preparing disclosure schedules, sellers are going to need to be very focused on how they are responding and in what time periods. I think buyers are going to be asking, almost like bifurcating pre-COVID period to COVID periods and comparing the two, because there's a lot of focus on how was the business operating prior to the COVID situation, how has it operated since, and then the expectation going forward. So there is definitely a focus on the difference and the distinctions between the two, and a focus on the effect. and then determining whether that effect is likely to be short-term or long-term, but at least they're looking at the business pre-COVID and the business post-COVID.
Yeah. And look, the importance of the representations and warranties, right, is it's the whole package that the buyer, says, I'm assuming these things are true. I'm purchasing these for my price. And, the seller is saying, well, we're not going to, include, risks that are well known to everybody. And the issue is going to be about bring down later on when we get to closing conditions. And so they have a different take depending upon whether or not you're going to have an executory period in your agreement or not. So Ainsley, if we can move to the next slide, which I think, there we go. Closing mechanics and considerations, right? So there's a fundamental decision that needs to be made as to whether or not you're going to have a sign and close transaction where you eliminate a lot of brain damage, negotiating covenants and closing conditions and behavioral things between signing and closing. Now, sometimes those are going to be necessary. For example, if there are regulatory issues or there are third-party consents and the comfort level that people have, particularly if there's regulatory issues, you're going to have one. Customer consents, on the other hand, most people are going to want them, but they don't want to go out to their customers or their other suppliers or anywhere but where they need third-party consent and then not have the deal happen. So they have to balance all of that out. Chris, we've been talking about, the risks attendant to having executory periods where one's not really required. What are the benefits or detriments of doing so from the buyer and seller's perspective on this stuff?
Sure. So I'll talk about what I think is the standard seller perspective. And then Alec, who we've talked to about in preparation for today, can talk about some of the different seller perspectives that are unique to certain type, particularly strategic, large corporations. So in the typical seller situation, you'd like to have the certainty of closing and to have that simultaneous signing and closing to the extent you can. So if it's a deal that doesn't require HSR approval, then sellers are generally going to push as hard as they can on having a simultaneous signing and closing. So then you're talking about, okay, what are the consents? And it's usually customer consents that are required. And then you take a deep, hard look at those customer contracts to see whether, even if it technically has a consent requirement in a change of control situation, we are seeing sellers really pushing hard beyond just what the words on the page say to say what's really the substance behind it. How important is it really to the buyer to get that consent? So for example, is it a contract where the customer already has an out for no reason on some limited notice? If it's that, and the customer could pull away, even if their consent was obtained today, they could cancel the day after, well then you argue very hard that that's not really shouldn't be a required consent. Here's the issue though. The issue is on the buyer side, which is buyers will often say, we don't really care what the contract says. We want to know that A, the customers are satisfied and on board, and that they don't have an expectation of pulling out once they hear about the deal or otherwise. And so I think where you're seeing a lot of that push and pull now is not just on the question of whether we're simultaneously signing and closing, but also in how much customer diligence is being done and when. So there's a real interplay between that customer diligence and getting the buyer comfortable that the customers are going to be staying around and not jumping ship, with the seller's desire for certainty of closing. So sellers always, they want to limit the amount of customer interaction. Obviously, they usually keep it till the very end of a deal, but even then, it's still limited to the most material customers. And I think now, in light of the current circumstances, buyers are saying, if you're not going to let me get these required consents, you're going to let me do a heightened level of diligence pre-signing, and so that we can have that level of comfort that gives us the comfort that the customers are actually going to stick around. So that's really the push and pull that we are seeing But Alec, I know you got a situation where you had a very different perspective from your seller client.
Yeah, we did. It was, it was a seller, and we see this, not infrequently, where they wanted to close on a month end, and it was extremely important. And you see that all the time, and you don't know, is that a real thing, or is that just the accounting department's really squeaky and they're not going to be bullied around on this? And that's one of those things that usually gets worked out. In this particular situation, we had some really long, detailed discussions with our client around whether that was smart, right? That look, we understand your usual push to get it done in month end. That's fine, but here, this might not be the right call given we're adding some number of days to this timeline, and we just don't know what could happen in that window. This was an auction process, and we had multiple buyers. One of the buyers came to us, took our initial draft purchase agreement, struck the closing conditions, struck the termination provision, struck everything that had to do with the interim period between signing and closing, and said, look, we're going to make this more attractive to you. We're going to do a simultaneous sign and close. This would be great. And we had to actually, we're in the weird position of going back to them and saying, yes, we would normally love that, but here it's not going to work. And so it makes you think, long and hard when you're in that situation about those other considerations that, months ago, you would have been okay saying, well, it's 15 days, right? Or it's 20 days, no big deal. We'll let the clock run. We'll do the month end closing. Everybody will be happy. It's just not that easy now for a lot of the reasons that Chris mentioned. And so I think it's, again, doesn't mean you have to do it. Again, in our situation, we didn't. We waited, we closed at month end. Thankfully, everything went fine, but it's certainly something that your client needs to be advised of.
Yeah, talk a little bit about what we were discussing yesterday when, if you're going to do if you're not going to do an executory agreement, the buyers are going to want comfort that you're not kind of playing them off of somebody else. And so that's the concept of exclusivity. And, sellers, on the other hand, might want to keep one or two people warm. And I guess that's going to depend upon, the strength of the company and the bargaining position and the like. You had a situation with a buyer that presented a unique and what the sellers were willing to do in order to not provide exclusivity to keep somebody interested at the table, or at least more than one party at the table. Why don't you mention that a little bit?
Yeah, it goes back to just the overall uncertainty of things, right? Where a typical process may develop where you've got a number of buyers and your teasers go out, you ask for indications, you get your indications, you whittle that down to some smaller group, and then presumably go exclusive, or the expectation, at least from the buyer's perspective, is that one of them's going to get exclusivity and have some 15, 20, 30 days, whatever the deal may be, to get the deal done. What we've seen on several occasions is, and again, this only works when you've got the leverage to do it, but we've seen in banker-led processes where the buyers or the sellers have just said, look, we're not granting exclusivity right now. We may do it at the very end, but we want to keep multiple buyers in the game. The ultimate fear being that no matter how badly your selected buyer wants to do the deal, no matter how excited they are about this process right now, about the potential of being your partner, about great purchase price and everything, what happens in 2 weeks when they go back to their investment committee at the last minute and they just say no for whatever reason, right? Some macro issue that may have nothing to do with the company, but the world's changed. And in something, in a situation where things are as rapidly evolving as they have been over the past few months, that's a real issue. And so we are seeing, exclusivity being denied until maybe later in the process, much later in the process, where you're running 1, 2, maybe 3 or more buyers marking up purchase agreement. I mean, it's difficult. You're doing that. You're marking up different purchase agreements. You're providing, massive, it's tough on the management team. They're providing massive diligence exercises, responding to questions from multiple buyers. It's really hard, but in a lot of situations, you see that because they're willing to do that because they want to keep those buyers warm. We've even had one buyer who said, look, we're not going to do that. And there were more discussions, and the seller agreed we'll reimburse your expenses with some reasonable cap, just because we want to keep you in the game. And for them, it was an insurance policy. They didn't want to pay that amount, but they were willing to pay some level of reasonable expenses to keep that buyer in the game, so they had a backup. And that's a reasonable business decision in this environment where you're worried that you just don't want to go through a whole process and find it all fall apart at the last minute.
Yeah, no, absolutely. And I think strategics are going to view this issue a little bit differently, particularly on the matters that Chris was talking about on the customer side specifically, because some customers may not want to deal with company X if they know that that's the buyer for whatever reason. And hopefully the seller has done some diligence themselves to test, those relationships and knows their customer well enough from just a pure relationship perspective that those things aren't going to be issues. So, but let's assume that, go ahead, Chris, sorry. I can't hear you.
So let me just jump in there and mention something we didn't mention earlier, just about who we are seeing in the on the buy side of processes right now. And I think one of the trends that we have seen, and obviously there are exceptions, but I think across the board, for the most part, we have seen strategic buyers pull back right now and become far less active. Most companies are really focused on their internal operations as a result of the current circumstances. And so we are definitely seeing financial sponsors being the primary bidders and participants in processes right now on the buy side. So I think that trend is likely to continue for a while until there's a stabilization in the market. So I think that one thing positive for this group to know is that financial sponsors certainly have an advantage right now.
Yeah, I think that's right. So let's assume that you can't do a sign and close, and you need to do an executory period. Ainsley, let's go to the next slide to see what we have to do relative to that. So one of the things, many things that we do is you have to deal with, well, how is the target going to operate between the signing and the closing? What is it that they can do? What is it that they can't do? To what extent is buyer consent going to be permitted or required for a company to take actions? And, we have some topics on this page that really hit home with respect to the current environment, that we are in. And in particular, there are two broad covenants that exist. One is that you're going to operate in the ordinary course, consistent with past practices. And the other one is, that, the buyer's consent to the taking of any actions that is on the thou shalt not do list will not be unreasonably withheld, conditioned, or delayed. So the challenge there is, how do you balance the interests between the buyer and the seller regarding those things, particularly in respect of, the seller's desire to maintain flexibility to be able to provide for appropriate responses if and when things come up. And these covenants relate to, the role of the material adverse effect provision. So why don't we talk a little bit about, the types of covenants that we are seeing, relating to that, and how buyers and sellers are pushing and pulling relative to those considerations. Alec, do you have any thoughts on that?
Sure. I mean, it's one of those situations where nobody's right or wrong here. I mean, you've got these sort of two diametrically opposed positions, and the seller looks at it and says, like, I need to be able to operate my business in the ordinary course. I'm willing to say I'm going to do it in the ordinary course, but these are not ordinary times. And so what does that mean, right? I need to have the flexibility to run my business because the deal's not closed yet. And we can't just be having to go to the buyer for every single change that may come up, especially when those changes aren't because I want to go borrow additional money or because I want to go enter into some material contract that the buyer may have permission for. The changes are directly in response to macro issues that are completely out of your control. And so, the sellers, for good reason, want that flexibility. The buyer, of course, has a very good point too. Look, I want to know what I'm buying. And if you change this business materially between the time we've signed and the time we close, that may affect valuation. And it may not be, I want to get what I bargained for. So it's really tough. The way we've tried to from a seller's position, you try to limit as you put the thou shalt not do items as much as you can. Try to get materiality qualifiers in there. Look for cushions or baskets to be able to thresholds before you have to go to the buyer and ask for permission to do whatever the applicable event is. And so it's just, in our experience at least, it's really fallen down to who's got the leverage in that particular situation, because it's really, I don't think there's a right or wrong answer here. I think it's just a tough issue to, and you're just trying to find a middle ground. Everybody wants to get to the same place, but both sides are very concerned about, what happens and making sure that you get there with your business in the same position or in a respectful position before you close.
Do you see differences between strategics and financial buyers, Chris, on how they would view those flexibilities and the like?
Yeah, I think only to the extent that it has to do with the financing requirements. I think that's really where you're going to see it. But again, from my perspective, I haven't seen a strategic buyer active in a process. Now, maybe that's my limited, but it's, talking to some of our colleagues, I think several of us have not seen any active strategic buyers right now. So it's a little hard to tell what strategic buyers are likely to be doing in this environment when they are really for the most part, sitting on the sidelines.
Yeah, I mean, I think that the covenants that these issues really touch upon are, the operation in the ordinary course, and what I would call the so-called maintenance covenants, where buyers try to get people to maintain relationships with customers, relationship with key suppliers, and other key third-party, business partners and the like. And there is a desire for flexibility because the world's hair was on fire back in, the end of March and early April. Things have seemed to have calmed down a bit, but frankly, these need to be looked at through the lens of the business itself, because every business has been affected differently by this. Some businesses are doing quite well because, their business model, they were able to change it, or they weren't as reliant upon certain key suppliers and the like, or they're within certain industries. But I want to touch upon the role of the material adverse effect provision. I think that, for deals that were signed in their executory periods prior to this pandemic really getting, where it was at the end of March and early April, there's a lot of testing going on. I don't know if we're going to see a full judicial opinion or a trial based upon whether or not an MAE occurred, but a lot of times you try to negotiate, maybe even within the reps and warranties, a material adverse effect qualification, or when you're doing the thou shalt nots, except to the extent that the doing of the action will not have an MAE. I think you're going to start seeing, I think this is still an issue. I think you're going to be seeing buyers and sellers pushing and pulling on whether and the extent to which pandemics and epidemics and viruses and the like are expressly included in them, just like you now see acts of terrorism added to what was traditionally in a force majeure acts of war, because you had courts saying, well, an act of terrorism is not an act of war in the traditional common law sense. So rather than relying upon the courts to come up with a determination, I think you're going to see that. The question is going to be in defining the MAE, whether epidemics and pandemics are described more broadly or whether they're more narrowly tailored to COVID. And I just want to make one point. Everyone talks about COVID-19. That's the shorthand version of that. Everyone, I think, knows that that's the disease. The virus is actually SARS-CoV-2. And then, the question is, do you include mutations and variations therefrom? That's a technical drafting point, but I just want to make people aware there's a difference between the virus and the actual disease. So however you write that is going to have impact in what the contractual rights are. There's also issues around, the disproportionate impact conditions to MAE qualifiers or on how Delaware courts view it. So Delaware courts have viewed MAEs, you got to have a long-term impact, a long-term adverse impact, in a traditional MAE definition. Here's the question. some of our clients were adversely impacted early on during the crisis, and some of them were going to have more lagging effects. So you're going to have to keep in mind, how when we're defining these things, does it actually impact your business? And it's really going to focus on the specific facts. And you're going to have to not just look at these as boilerplate, but really be thinking about whether you're a leading or a lagging indicator of whenever there's a government shutdown, or if something were to happen in the chain, when are you going to be adversely affected by it, and how long is that going to take? Let's move on to the next slide. Okay, so at the end of the day, all of this drives to protecting purchase price, right? Buyers want to protect their purchase price through the representations and warranties, through the conduct of the parties, through the operating covenants, and sellers want to protect the purchase price by not having grab backs done on the basis of technical breaches or for things that they don't view as having been different than the business that the buyer purchased. So, these touches upon the scope of the fundamental representations and warranties. Typically, that's things like organization, authority to do the deal, matters like capitalization. Sometimes you see, separate carve-outs for environmental and for employee benefits and taxes, but some people are being a little aggressive on this and, want some protection on the COVID aspects of things. Are we seeing anything in that regard, or on the PPP, frankly, about forgiveness and the like? What are we seeing in regards to fundamental representations and warranties or specific indemnities on some of these topics?
Well, I think from my perspective, one of the things that you're going to see is a question around the PPP loan application. So as we know, loans under 2 million, they're going to be deemed to have made the need certification in good faith, but that doesn't apply to loans over 2 million. And if there is actually evidence to the contrary, that deemed good faith assertion is not going to be respected if there's obvious evidence. So one of the questions is, does the PPP loan application and all of the certifications made in it, should that be a fundamental rep? Because that obviously could result in more liability to the company than just the amount of the loan itself. So there is some debate as to the where and whether that should be capped, because even if the sellers are getting out, whether the people who were there who made the certifications, it's not just the individuals having liability, it's the company having liability for it, and that liability in some cases could be significant. So that's one area, Chris, where I think around the PPP loan, we're going to see some different approaches to reps and warranties and indemnities.
Yeah, I think you might see some specific indemnities on that rather than a rep and warranty one. And I think it also depends upon how the loan's treated, right? I think you might see specific reps on the adverse governmental impact. There's economic impacts as to forgiveness and whether or not that happens, but there's the risks associated with False Claims Act and the unknowns associated with that. So I think you may see some of those types of things. Alex, do you have any other thoughts on the interplay between those things?
Yeah, it's interesting. I mean, it's one of the, from a seller's perspective, you say, wait a minute, you would never ask me to make a compliance with laws rep fundamental. What's different? I think the difference here is this isn't a generic compliance with laws rep, right? This is an identified issue with specific risks, both known and unfortunately unknown, because we're all living this real time. So I think you will see a lot of that. One other thing that we're seeing, which is a little bit of the flip side there, is a push on both sides for more deals that are structured as no seller indemnity deals, where the seller literally has no indemnification whatsoever. Buyers look at that. I think the argument that you've typically seen there over time is that gets the deal done faster, right? Buyer gets kind of the reps that they want, and you get less bogged down in negotiating the reps because the buyer says, oh, you can make this, you're not standing behind them. So that's obviously not from a seller's perspective, that it's not that easy, but it is a way to make the process move faster. And when we start talking, going back to our previous discussions on trying to get to a closing and get a certainty of deals, I think we've certainly seen those. I don't know that it's more frequent, but I think it's attractive, right? It's attractive for both parties who want to get a deal done quicker. That's one way to hopefully get there a little bit faster.
Yeah, I think you touched on a topic earlier about a general representation about compliance with laws, right? That would normally have a sunset period. It goes to the notion of the representation and warranty insurance market. I mean, I know you did a deal, Alec, that recently had a representation and warranty policy. One thing to bear in mind is they're willing to underwrite the risk of whether or not a representation and warranty is true. They're not willing to underwrite business risk. And so to the extent that the representations and warranties are trying to insert business risk, the sellers and the rep and warranty insurance provider are aligned in that respect. So I think it's very interesting about what we're going to see in the marketplace going forward. I think you might see some really broad exclusions and potentially overly broad that says, we're not liable for anything to the extent that it was COVID related. Well, I mean, in this environment, a lot of things could be COVID related. And, when some reps are being made, not necessarily with the impact of COVID, but you're either underwriting the truth or accuracy of that rep or not, maybe not the specific COVID rep. I think there's going to be different industry approaches, to these kinds of issues. And then even potentially how these insurance contracts are written. So for example, if there's a broad policy exclusion, well, then that burden of proof is on the insurer to demonstrate there's an exclusion. But if they put it into the definition of a loss, that, the loss doesn't include losses associated with ... that would be something that I think the insured is going to have to show didn't exist in order to satisfy the definition of loss. So that market is evolving. Chris, did you have something to add?
Yeah, I was going to say, I think that where you're going to see a heightened amount of diligence being done, particularly take, for example, that the typical rep that customers have not indicated any intention to either reduce or terminate their relationship. Well, if there's a breach of that rep, traditionally that would be covered by rep and warranty insurance. But in the current situation, if the customer has done that because of the COVID situation, I can see the insurance company taking the position that no, that's covered by the COVID exclusion. And so all the losses that are attenuated to that are going to be excluded. So I think you're going to need to have a lot more buyer diligence on the things that could be not just the breach of a COVID rep per se, but where the breach of a rep could be significantly exacerbated because of the COVID situation. I
think that's right. And that's where the tug and pull is on these rep and warranty insurance policies. I mean, I would argue that's why there's a cap on the policy amount. That's why there's a deductible when you're negotiating these. And, there's right now a market hasn't necessarily developed. This also goes to the question of, the insurance company's oversight over the buyer's diligence and the extent to which maybe they're going to get more involved with the process. And it goes to the question of executory versus sign and close, right? Because insurance companies aren't going to underwrite interim breaches of covenants that, or interim breaches of the reps and warranties where there can't be a bring down and, either a waiver of the condition or we're not closing. And so, the insurance companies want to underwrite the reps when they were given at the time of signing. So it's another consideration. So anyway, we're getting close to the end. I think we're at the end. Ainsley, if you want to go to the next slide. I think we perfectly timed it. So thank you all for your time. We really appreciate you taking the time to hear what we had to say. If there are any questions, as Mary Brown said earlier on, please send them to SBIA. Here's our contact information. Feel free to reach out directly to any of us. We provide value to the members of SBIA. We're proud to be a part of the organization, and we thank you for your support.
Chris, Alec, and Chris, thank you all very much. We appreciate the time and expertise that you've so graciously shared with us today. As Chris said, the Troutman Pepper team has generously agreed to respond in writing to any question that we were unable to address during the webinar. If you have a question that remains unanswered, you can email it to info@sbia.org. A recording of this webinar, along with the presentation materials, will be distributed to SBIA members. You may also visit our website, sbia.org, to view a recording of this webinar, along with all of our previous presentations and materials. If you are not an SBIA member and would like to learn more about joining our organization, please contact my colleague, Alex Frick, at 202-628-5055 or email membership@sbia.org. Finally, in closing, we ask that you please mark your calendars for our next Lunch and Learn session on Wednesday, July 29th at 11:30 a.m., where we'll cover the GP-led secondaries market, growth and opportunity. Thank you again, everyone, and we look forward to having you join us soon.
Is it just us?
Oh.
Sounds like SBIA even bagged off the call.
Hopefully it's
guys.
over. That was good. That went well.
Yeah, thank you. Did great.
We did have a couple of questions.